Hello, property investors. Welcome back to another session, our facilities management, utilities management here on Facebook. So I'd like to jump straight into our theme for today. Today we're going through the idea of financial management or your finance management when it comes to your properties. And specifically, we want to talk about the difference between your maintenance costings and your capital improvement costing, and how to deal with them in their specific manner. So firstly, I want to just start by saying that I'm obviously not a tax practitioner. So you really do still need to deal with your accountant, your tax practitioners, to make sure you're getting the right sound advice. So this just gives you sort of a high level idea of what to look at and how to distinguish the difference between your maintenance costs and your capital improvement costs. And there's a reason for it. So if you do specifically want to get a little bit more information around the financial implications, so like your tax implications, that sort of thing, I really do suggest that you reach out to the team at Intergen. You can get hold of them on their website. So it's intergen.co.za, or alternatively, in the description after this video, there should be their link through the SAP and Connect page. So I really do encourage you to reach out to the team at Intergen. They'll help you with structures. They'll help you with putting in place the right structures. So be it trusts, be it companies, that sort of thing. And they're the best people to give you some tax advice around anything specifically you're wanting to do with your property portfolio. So having said that, I really do encourage people to manage their portfolio as if it's a business. And I think that's super important, because you can't just be doing it as if it's a hobby. You need to have the same structure that you would have for a business. If you're working for an employer, or if you were a entrepreneur, or if you had a business, you were running a business, your property portfolio should be run in the same way. So that means you need to keep financial records. Okay. So it's super important to keep financial records, and that means keep all your slips, all your transactions that you make. You need a track record of all of the slips. You need to have those slips available to prove the expenses that you've had and to prove why you've allocated those expenses for specific things. Okay, so I talk about the difference between maintenance costs and the difference between capital improvements, because there is a reason to distinguish. When it comes to capital improvements, what those end up doing is it becomes big ticket improvements to your property. So where it improves the equity in the property. And the reason you're paying attention to that is because if you eventually sell your property, there's going to be a situation where you're going to have to prove what the renovations were on the property, any capital improvements, that sort of thing. So as you decrease the amount of capital gains tax that you would have to pay on the property. So obviously, there's different criteria around capital gains tax. Again, have that discussion with your accountant to make sure you are optimizing as much as possible. But it's important for you to keep the records and to put them into different silos. So from a capital gains tax perspective, if your property, when you sell it, is now worth more than what it was when you bought it, and that's really the goal for all of us, as we're trying to improve the equity. As an example, you bought the property for 500,000 Rand 10 years ago. You're now looking at selling it for $1 million or more than that. So if you're calling it $1 million, there's been a capital gains. So from the purchase price of 500,000 to the $1 million Rand that you're selling it at, there's that 500,000 Rand capital gains on that property. Now that capital gains, unless you're very lucky, it didn't come from nothing. So it's generally from you improving the quality of that property from when you purchased it to when you sold it. So that means you've done renovations, you've repainted it, you've redone kitchens, you've redone bathrooms, that sort of thing. So those are capital expenses that have been adding equity, adding value to the property, and you're taking that into account. So when you sell the property, you've got the records that say, listen, for that bathroom, I spent 50,000 Rand. For that kitchen, I spent 200,000 Rand. And that then adds onto the purchase price of the property. So your 500,000 Rand that you bought the property for, plus the 50,000 Rand for your bathroom, plus the 200,000 Rand on the kitchen renovation means your input into the value of that property is now 750,000, and the profit then is now what's left over between minusing from the R1 million selling price and the input price of obviously those purchase price and the renovations. So you're left with 250,000, which is your profit, and that's what you're trying to reduce that profit by allocating the real costs of the purchase and of the improvements to your property. So you're allocating those costs to get the value and to look at the difference in your profit there. So I think that's in a nutshell what you're trying to do there, and it's very important because you do want to reduce that cost of your tax down the road, because you want to pay what is just as far as your tax goes. Okay, and then when it comes to maintenance, you're looking at that as differently, and I think that's super important, because when you're doing any big renovations, you know straight away I'm allocating this to capital improvements because it's improving the property, and I'm allocating it towards the value in the growth in the equity. When it comes to the maintenance side of things, those are ongoing maintenance elements. So the costs of the upkeep of the property, and that would be from, if you've got a tenant turnover and you have to send in a team to clean the property, to repaint the internals of the property, that becomes a maintenance item. Okay, if you've got to send in cleaners, if you've got to replace or repair broken roofs, roof tiles, if you've got to send in maintenance teams to do plumbing repairs, to do electrical repairs, if there's a leaking tap, if there's a leaking toilet, so you're sending in contractors for small maintenance once-off items. Okay, so that's really the distinction between a bigger project being a renovation and just your maintenance, your ongoing maintenance. Okay, where there's a little bit of space where people get confused is if, for instance, their stove or oven breaks down and they now need to replace that oven. So generally, if you are repairing an existing item or like for like, so like a fixture being an oven, if you replace a specific brand of oven with the same brand, then that's technically a maintenance task. But if you went from a sort of more economical, cheaper brand and upgraded to a more expensive brand, so as an example, you went from a Defy oven and you now installed a Smeg oven that's now 10 times the price, you're now looking at a difference between it being a maintenance item and now it is a capital improvement item, because theoretically it's giving more value to your property. In that situation, you can't allocate it as a maintenance item. You should be allocating it towards being a capital improvement budget item. Okay, so those are the only times that it kind of gets a bit confusing. But the rule of thumb is if I'm replacing like for like, then it's classed as a maintenance category. If you're upgrading to a higher quality and the impact of that upgrade means it improves the value of your property, then you're allocating it to capital improvements. So anything that you have costed to maintenance through the financial year, you can't also cost or allocate it to capital improvements in your balance sheet down the line. Okay, so it's important to distinguish that. The reason you're allocating maintenance to your budget through the year is because that becomes an expense line item. So your rental income less your expenses then shows what your profit is from that property itself. And if depending on what entity you're running that property in, if it's in a company or PTY limited, that profit you're then paying the company tax on that profit that's left over. And if it's in your personal name, the same situation, you're paying income tax on that profit that's left over. So it's important to distinguish between the two. If you now claim that as a deduction from your yearly income tax or profit, you can't then claim it from your capital gains tax when you sell the property. So that's one of the main reasons why you're doing this. Again, what I do encourage is that you reach out to the team from Intergen, you speak to them, You ask them, what is the best solution? Right from when you're starting to think about buying properties, get your structure right with Intergen and the team. Make sure that they're putting you into the right space from the get-go. And my big thing is always manage your property like it is a business. Don't manage it like a hobby. You got to think generational wealth. You've got to think about improving it for the next generation. You have to have in mind the idea of how do I make sure that it's easy for me to sell if I have to, easy for me to manage and run, so as it becomes something I can outsource to someone else when I'm retired and on the beach all the time. So that sort of mindset. Thank you very much for joining me today, and we'll see you at the next one.